Hey everyone, hope you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to go through Twitter, see what people are talking about on social media. I'll share my financial opinions as we go. It's going to be related to wealth building, financial topics, and or commodities. So let's dive in there. Let's see what people are chatting about. If you want to follow me at finding_finance, and if you want to join our community, finding-value.com is where you need to go if you want to join our community. LEAP is the discount coupon code, LEAP, because we're in leap year. If you'd like to join, and a reminder, Sunday, 5 p.m. is our question and answer session for the Platinum members. So coming on down, Paul says, goal number one, and think it's crazy not to be given the levels and, well, everything else. All bears have is warm weather and two of them are priced in. This is where it's supposed to be easy to be a bull. Big move will take time, but it's up soon. He said, how's that? You just mean sentiment. Tell me one thing that is fundamentally bearish outside of weather, which is as bad as it gets to end February and priced in. Come on down. It's too unpredictable in the short term, always is. I mean, could say yes, and the free port could be back tomorrow, and I'd look pretty dumb. All I can confidently say, is the Bears' turn is over sometime between now and March 15th. And I agree with his positions. And really, you want to look at power burn. So this is where the supply ain't ample. That's relative, and what supply-demand balance is made to measure. Domestic demand is on trajectory for 93 plus at these levels of power burn, and net export is 15 right now and will soon be 17 plus. It is if you are taking into account the massive glut but storage shrinking versus the 5-year is bullish for price and is all but guaranteed to happen with a supply demand balance so tight. As soon as we hit mid March, it will be on lock. I agree. I think we've got some here. I am surprised at how good of a setup and how cheap it is before the wall of LNG terminals come. Been ramping up our power burn quite dramatically. So if you look at this from a longer term perspective, if you don't just look at the price right in front of your nose, if you look out a couple of years, it's like, man, we got to really start to produce a lot more natural gas if we're going to feed all of the liquefied natural gas terminals and at the same time do as much power burn, burn natural gas for electricity generation. And we've got AI coming. AI is going to absolutely drain electricity in terms of demand. We've got Jack here. He says, out now, Paul Sankey's outlook for oil in 2024 and beyond. This is his opinion, Paul's opinion. Saudi Arabia is bailing out the oil market with voluntary production cuts. AI will cause power demand to explode. The market is at equilibrium at about $80 a barrel with Saudi voluntary production cuts. It's hard for crude gusher to be wildly bullish as Saudi has tons of spare capacity it could switch on. The tail risk for oil is to the downside, not the upside, in his opinion. $80 oil is good for mega cap oil stocks with low break evens, which are generating record cash flows. Paul doesn't think a major bull run will occur until U.S. production declines. He expects U.S. production to grow this year, but at much slower growth, potentially zero growth in 2025, but it depends on the price. Natural gas is really suffering. Saudi cuts are bearish on natural gas. With the AI craze, investors don't care about oil. As trading vehicle, large cap oil stocks are unattractive, but for long-term investor, this is a great opportunity. Paul agrees with Warren Buffett's decision to sell Apple and buy Chevron. There is almost no interest among serious investors right now in small cap oil companies less than 5 billion. Inventory matters. Sorry, But your 60% free cash flow yield microcap likely has horrible reserves. The market rewards long life reserves and punishes short life reserves. The merger and acquisition (M&A) cycle is underway in oil, but the deal premiums are tiny. This means large caps like Exxon and Chevron can scoop up small caps on the cheap. So bullish for majors and not bullish for small caps, in his opinion, because of the inventory. Paul expects most oil mergers to close this year because in election year, politicians don't want another oil price spike. Fortunately, during this M&A cycle, CEOs, not shareholders, have become rich. This is because change of control provisions incentivize CEOs to agree to deal at too low of prices. Paul likes Spain's proposed merger with Endeavor a lot. He is less keen on Devon's rumored bid for Interplus. Oil productivity is rising. The industry needs fewer wells to produce more oil, in his opinion. That's what sums that up. Lynn says, in fact, the reason I started emphasizing macro in 1617 is that it was the first time in decades that the deficit as a percent of GDP began rising during an economic expansion. That was the early stage of a structural fiscal dominance. So this is the federal surplus deficit here. You can see that we're running deficits ever since ever since 2000, really. Deficit, deficit, deficit. This is where she circled it, but huge deficits, and we're running more and more deficits with time, which is a stimulus. There's a stimulative measure when you run deficits. It's a stimulative by nature, inflationary. Now here's an interesting one, guys. This caught my eye, and it's probably one of the most interesting charts that I've seen presented because I don't fully understand it, but I kind of understand it. It says adjusting the U.S. yield curve for the funding mix, i.e., the huge scale of Treasury bill issuance, gives a very different view. No inversion and pointing to economic rebound from around now. Wait a minute. So all these people are talking about the the inversion of the yield curve, the 2 and 10, or 10 and 2 in this case, year spread. But they're saying it's because of the funding mix and the huge scale of Treasury bill issuance. And somehow, I don't know how they adjusted this because it's an actual versus adjusted. This is the actual coming down. But if you look at the adjusted, we have no inversion and inflection from February of 2023. Now, does this mean that we don't get a recession? What exactly does this mean? I still think it's going to cycle back up because I would expect that rates are going to have to come down at some point. But they're saying that we could get an economic rebound, which means that maybe it's not as bad as what most people think. This is obviously a different viewpoint, and I wish I could explain their viewpoint better. The way that I read this is based off of the Treasury bill issuance and the just sheer supply of it, that the yield curve may not be inverted because of the economy, but is inverted by the issuance that the government's been doing. And perhaps it's a false signal. I'll just say I don't know. I don't know about that. As this cycles back up, I would think that there's a slowdown and rates do come back down, but we'll see. I'll just say we'll see. Yield curves have an incredible track record in anticipating recessions. However, it's important to note that there's a lag following an inversion. On average, recessions have occurred 12 months after an inversion, but only 5 months after a steepening. He says the current steepening indicates that a 2024 recession is very probable, especially if monetary policy continues to remain tight. And that's what his opinions are. And he's talking about this. So I've got conflicting data here. Some people think that we are going to go into recession. Others think that because of the Treasury bill issuance, that the rates on the 2-year have gone up enough where it messed with the signal. I'm in the camp that firmly says, I'm not sure. I'm not sure because we've got a lot of stuff occurring all at the same time that hasn't really occurred in history of all these other times. All these other times we had low debt, the curve inverted for the most part from the real estate cycle. This curve has inverted, I don't think from the real estate cycle as much, but more from the stimulus money that came into the system. So if they lower rates, I think that the market will kick back up and that the housing market's going to kick back on and we'll get more monetary inflation back into the system. These other times in history, that it inverted from an inherent weakness in the market. Now, could we get an inherent weakness from something that isn't real estate driven? We could, and that could be, the destruction of business loans and other loans in the system, car loans. It's very much possible, but it's not as straightforward as the previous uninversions. Here's Celsius Energy. It says as much as the U.S. nat gas storage glut has been ballyhooed, the European situation is even worse. The surplus versus the 5-year average stands at 710 billion cubic feet, and inventories are 100 billion cubic feet above the previous 5-year high. If the situation does not improve, expect LNG cargo cancellations this summer. So we've got warm weather, we've got around the world, and their inventories are not draining over in Europe, and we're not really draining our inventories. I know some people are banking on the LNG terminals coming up to really start to ship out with a bunch of takeaway capacity. But I mean, if Europe's natural gas inventories are also high, maybe that demand isn't as high as what a lot of people are expecting, even for myself. So this is something to watch, and this is something to keep in mind is that they also have high inventories over in Europe. And that's this one here. It's most bearish. Tavi says, meanwhile, the US monetary base has been rising significantly recently. In the last 12 months alone, there's been a rise of 420 billion, primarily fueled by bank reserves. While the Fed should not classify this as QE due to mechanical differences, it unmistakably echoes the patterns of previous periods of monetary stimulus following the global financial crisis. The economy's reliance on easy money policies have become akin to an addiction, rendering it incapable of sustaining itself without them. These are fundamental policy constraints that have yet to drive the value of hard assets significantly higher. So QE1, QE2, QE3, we've got the COVID stimulus, and then we've got more similar quantitative easing that's going into the banking system for our US monetary base. But I do know if you were to look at some of the bank lending, it has slowed down versus, some years ago. So monetary stimulus has slowed down to some degree, but it is kicking back up here recently. JC says, I'm a little more old school than some of you, but I'm old enough to remember when Apple used to be a big deal around here. In fact, up until a few months ago, Apple was the biggest deal of them all. Are you one of those people who thinks Apple no longer matters to this market as it has a new 3-month low and it looks like it's rolling over? Is that a precursor to the S&P 500 rolling over? We'll see. Oil demand rose to a new seasonal high in December by about 500,000 barrels a day as gains in Asia more than offset declines in the US and Europe. Jody data available for free at the link below. The oil demand's about 500,000 barrels per day for, they've got December 2022 here that they're showing, but it's really for 2023 data is what they've got. Barry says, I'm on the other side of this trade. This camp of economists has not been right in a long time, and I think they continue to use the wrong decade's playbook for the post-COVID era. It says not the 70s, but the 1950s. There's a meaningful chance that maybe it's 15%, that the next move is going to be upwards in rates, not downwards. The Federal Reserve is going to have to be very careful, according to Larry Summers. Dan Edwards says this. It says that is a gap fill as far as I'm concerned, and he's talking about URNJ. I'm going to open this up, and I'm just going to say a couple of things that are kind of obvious to me. These big down candlesticks, they're on volume, guys. They've got some good volume behind some of these down candlesticks. So I don't think it's just a gap fill. I think there's potentially maybe a little bit more behind this, and it could stick around a little bit longer than maybe what most people think. So yeah, there's a gap fill, but at the same time, we're also selling off with some volume. And it's a pretty big down candlestick, which has some momentum behind it. I'm not trying to be bearish, but the price action is bearish. It is. We really need to see some positive construction in terms of turning this thing around and turning that momentum around with some volume is what I would like to see for me to get bullish at this time. Oil prices could surge to $120 a barrel if there's a wider, prolonged conflict in the Middle East that disrupts oil and gas shipping in the region, the Institute of International Finance has warned. So the one guy above, his name was Paul, says, yeah, $80 seems pretty reasonable. He thinks that there's, some downside risk in oil. Energy Headline News says, no, we could go to 120 if the Middle East gets any type of disruption. And that's the news, guys. You get all this conflicting data and conflicting opinions, and that's what makes the markets. Who's right? I don't know. And I just go by what the charts kind of tell me, and I think we've got a good shot of breaking higher. That's me. But yeah, we'll see. Global oil demand hits seasonal highs for the 8th time in a year. We've got Calvin here. He says, pretty crazy chart. ICE vehicle production actually increasing despite the narratives. So we've got ICE vehicle production up 8% in 2023. ICE vehicle volumes up 8% compared to the 3% expectation at interim. These are the ICE and hybrid vehicles against battery electric vehicles, but this is the ICE and hybrids. I don't see a little thing here, so I just see ICE and hybrid. Must be ICE here and hybrids there, or battery electric vehicles. Yeah, but it's up. We've got, sounds familiar, eh? So this is Druckenmiller, 1987 collapse. I wanted to go over this again. It says, what determined the timing of your shift from bullish to bearish? And his opinion was it was the combination of a number of factors. Valuation had gotten extremely overdone, which we have today in a lot of tech stocks. The dividend yield was down to 2.6%, and the price to book value ratio was at an all-time high, which we do have today. Also, the Fed had been tightening for a period of time, which we have. Finally, my technical analysis showed the breadth wasn't there. That is, the market strength was primarily concentrated in the high capitalization stocks, with the broad spectrum of issues lagging well behind. This factor made the rally look like a blow-off. I think this is the same type of situation, guys. I mean, we have all of those conditions. So is it going to repeat in 2024? Could. Sounds very familiar. BHP's economic and commodity outlook is a must-read, especially for the copper investors. So let's go through it really, really quick. It says a primary focus on financing through presumes that the projects are ready and waiting and funding is the bottleneck. The reality is more complex. The industry's collective set of development options is modest by comparison with prior decades. With the well-known lack of discoveries, the depth and complexity of what has been found, and the lengthening catalog of above-ground risks and regulatory hurdles that confront project developers all add to the challenges of bringing additional copper to end users in a timely fashion. Technological progress can help at the margin to improve the productivity of existing operations, including innovative leaching, where BHP has several studies underway at their Chilean operations. But the binding geological realities feel like the stronger force for the decade at least, for this decade at least. So they think that the geological realities are stronger than the technological improvements. In closing for this chapter, we reiterate our view that the price-setting marginal ton a decade hence will come from either a lower grade brownfield expansion in a mature jurisdiction or a higher grade greenfield in a higher risk or emerging jurisdiction. None of these sources of metal are likely to come cheaply, easily, or unfortunately promptly. A decade, though, is a long time, and between now and then, with the conditions we anticipate in the final third of the 2020s, it is entirely possible that at times the cost curve will cease to be binding on price. An alternative pricing regime, which we'll refer to as a fly-up, whereby prices disconnect from the cost curve due to the systemic excess of demand over supply amidst critically low inventory levels, as a scenario that we feel the ecosystem should start preparing for today. So let me rephrase this. They think that the stronger price dictating factors are geological realities versus the technological improvements. So they think geology is going to win out. They don't think that there's going to be new mines coming online very easily or very cheaply. And lastly, they think that there's going to be demand destruction, not necessarily riding on the cost curve. I exactly agree. And I think that's going to occur in a lot of different commodities. I think it's going to occur in platinum. I think it's going to occur in copper, in oil, maybe even in natural gas, depending on the weather, I'll say. And that's what I've got for today, guys. So give me a thumb up for the content. Subscribe to the channel if you haven't already. Subscribe to the website if you'd like. Sunday, 5 p.m. Mountain Standard Time is our question and answer session. As a reminder, we do have a discount going on called LEAP, L-E-A-P, in the discount code. And that's what I've got for today. So we'll catch you later. This is Finding Value.